Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. Joining me today, the head, the governor, the man in charge of Beckertown, USA, Mr. Michael Becker. Michael, how are you?
All doing well. How are you?
I'm doing great. Another hot day in Texas. So
seems like they all are. It's hot and doesn't rain.
It never ends. It's like being in hell. It doesn't get any cooler.
It will in October eventually.
For a second, Paul, I thought you were calling me the governor. That means I must be I must be the butler then if Mike's the governor.
All right. So we're going to introduce that unknown voice to everybody in just a second. Let's say hello to the professor himself, Mr. James Eng. James, how are you?
Good. Thanks for having me, Paul.
The unknown voice that you just heard was one of our friends from that great real estate firm called CBRE here in the Dallas-Fort Worth area. Danny Baker is our friend. We've known Danny for a number of years. He has helped lots of you buy large multifamily properties in the Dallas-Fort Worth, Texas area. He is a professional. And so he's going to give us kind of an update about what's going on in multifamily. But before we do that, James, tell us a little bit about the Old Capital Conference.
So September 14th and 15th, here in Dallas, we'll have 500-600 of our close friends come into town or drive over from Uptown or South Lake or wherever they are here in Dallas-Fort Worth and have a couple drinks on Wednesday night for the happy hour in Addison. And then on Thursday, we have a full day conference over at Texas Live. So go on to oldcapitalconference.com and get your ticket before they sell out.
And they will sell out because that's a great networking event for people throughout the United States to talk to other limited partners, talk with general partners. It's a great opportunity. If you're thinking about getting the multifamily and being an investor or even a general partner to operate these properties, this is where you find your friends and other people that are involved in these transactions. All right, we're going to talk with Danny Baker. Michael Becker, let's kick us off.
So Danny, maybe you're not my butler. We did carry my bags on a transaction earlier this year and got it across the finish line. So we do appreciate that,
Michael. That's very
good.
Yeah, you're a heavy packer, Mike, but I appreciate being involved.
So maybe start. We had you on, 5 years ago, maybe 4 or 5 years ago. We had you on the podcast. Maybe 6 years ago. It's been a while. Maybe for those that aren't long-time listeners, kind of go through, do kind of quick little brief introduction and background on yourself so we kind of get to know who you are.
Sure. I run the multifamily investment sales group here in Dallas, Texas, covering North Texas. We've got a team of 17 professionals that work on the CBRE investment sales practice here in Dallas, brokers and support staff. And then we have our debt professionals as well that obviously place debt capital for buyers and developers of multifamily assets. CB is obviously a large company. I think our market cap is about $27 billion. We have 105,000 employees globally. And in the multifamily capital markets vertical is the largest vertical in the company. So certainly a lot of resources, time and attention paid to the multifamily sector as it's become one of the most important sectors in commercial real estate. My team here, we do a significant amount of volume. Last year, we transacted about 25,000 units, 93 assets in North Texas. And so far this year, either sold or contracted for 73 multifamily communities, about 18,000 units, $3.5 billion in volume. So certainly see, feel, and touch every corner of the multifamily business here, from high rises to value add, single assets to portfolios, outright sales to recaps, as well as raising capital for developers and land sales, I should say. So we have our finger in every facet of the multifamily investment business here in DFW, as well as across Texas. And we have partners throughout the United States, and we're closely joined at the hip with our partners in the Sun Belt to include Charlotte, Raleigh, Atlanta, Phoenix, and then obviously the other Texas markets with Austin and Houston. So I think across the Sun Belt last year, just between Dallas, Atlanta and Phoenix, we did about 17 billion in volume. So we are data people and certainly like to aggregate that data and use that to our clients' advantage when going into every single engagement.
Yep. And then before CB, you one long time ago thought you'd be Jay Powell or Bernanke or somebody like that, right?
Yeah, that was kind of the initial plan. Plan A would have been interesting. Plan B pays the bills a little bit better.
Well, I don't know. They had all those profitable stock sales not too long ago, so I guess that's off the table nowadays. Well, cool. Well, so kind of as a reference, we've known each other a long time, done business together. Most recently, you sold an asset for us that we ended up buying in 2019. Sold it for a nice outcome earlier this year, and it was absolutely probably we couldn't have waited 5 minutes on that transaction before the market started kind of turning a little bit on us. Maybe just do a kind of quick little brief background from your perspective. How's the last 12 months been? Because there's been some pretty darn highs, and now we've kind of pulled back and feels kind of like we're at some lows and maybe kind of building a little base of support is my perception right now. But maybe kind of go through the last 12 months of your world.
Sure, absolutely. So I'll start with where we were, where we are, and then if it's okay with you guys, I'd like to just highlight a couple of things that haven't changed. And I think it's really, really important that investors remember the reason that you're investing in apartments. So I have a couple of quick stats that I pulled from the Census Bureau that I think would be interesting. So first quarter of 2020, obviously an extremely challenged year, back half weighted given the essential freeze in the market through the middle part of 2020. Back half of the year started ramping up from a transaction activity perspective. And almost every single one of the transactions that we worked on in 2020 was financed by the agencies. 2021, there was a trough in activity in the first quarter. Things picked back up in, late first quarter, maybe the first month, the second quarter. At that point in time, there was a new, maybe not new, but more prolific entrant to the market in the form of debt funds. And the interesting bifurcation between the agencies and the debt funds, there's quite a few differences, but the underwriting differences allowed for investors to push more aggressively on underwriting assumptions without sacrificing leverage. So throughout 2021 and the early part of 2022, we saw a fairly steady decline in multifamily cap rates in the Sun Belt, where there was high levels of growth and the ability to secure financing that took that growth into account when compared to the agencies that look at current income and a debt coverage ratio. So where we are today, we've come a long way. And I almost call this a mini cycle from effectively, call it June to June, right? During that period, I would say was probably the most prolific transactional 12 months in the history of multifamily. $28.5 billion of multifamily trades in 2021 alone, with the second highest peak year was like 12 or 13 or something like that. So tremendous amounts of volume had been accomplished in 2021. And then 2022, we certainly started out with a very high level of volume in the system throughout the course of the first quarter. And then we entered into a Fed tightening cycle, which has obviously dramatically impacted the floating rate financing market and the cost of capital, which has caused, I would say, a pause in investment activity for the most part during this middle period where investors are trying to figure out how to underwrite 50 to 70% of your capital stack, which, if you track the SOFR curve, changes every single day. So I would say where we are right now compared to June of last year, from a capital markets perspective, a significantly more challenged time. Although when compared to industrial or compared to office or retail, obviously has its own set of unique challenges. When compared to other commercial real estate asset classes, we have something that they don't, which is one, the ability to mark leases to market on a daily basis. And two, we have the GSEs, Freddie and Fannie, which provide, their mandate is to provide liquidity in times of economic volatility, which is exactly what they're starting to do right now. So drastically different capital markets environment, but still, I would say the broader sentiment, divorcing ourselves from the capital markets discussion, the broader sentiment around the apartment sector is still extremely positive for those investors, which is most of them, that are investing for fundamental reasons, meaning boiling it down to two curves, which matter the most, supply and demand.
So I saw the beginning of this year, The transaction you worked on us is a kind of a good example. I don't remember how many tours we had, but it felt like you probably should
Like
have
50.
You should have probably moved in got yourself a one bed out there because you guys were living out there. So
I couldn't
50
afford
something
one bed
tours.
out there, Mike. You were pushing the rent so hard.
So 50 something tours. We got 25, 30 offers, of which I think that there's around 10, 12 that were kind of bunched together at the top. And then at the end, we moved, I think 5% or so, kind of the best and final rounds, which is a huge move. I mean, multiple $1 million move in the best and final round on this transaction. And it was every flavor of the rainbow, right? We had private guys, we had institutional guys, we had some exchange people, some JVs with fund money backing them. So just kind of everything you could think of. Guys paying all cash, it would close in a week, and then all the way to fully levered buyers that needed some time. So that was February, let's call it. So fast forward to today. What if that same transaction is out now? If I'm selling a Class A deal, which this was, or I'm selling a workforce housing deal, which this wasn't, and you sell both, quite a bit of both. What does the buyer pool look like today, and how is that different than February?
It's significantly more heavily weighted towards private capital investors today. And I would say that there's a little bit of commentary here that I don't want to be misleading. I believe that we have a liquidity issue right now, but we don't want apartments liquidity issue. It's very difficult to transact. It's very difficult to find accretive debt, and the market's going through a reprice. So we're going to wait a little bit and see where ultimately we're going so we can start drawing a trend line here. So in situations like that, generally speaking, you see institutional money go to the sidelines until there's some semblance of clarity around what the trajectory here is. So just like in COVID, the first movers into the transactional market have been predominantly private capital investors. Now, there are some institutional investors in the market right now still, some all-cash buyers in the market today still, not nearly to the level as they were in the first quarter. So I think the next couple of months, or however long we're in this period of uncertainty, it's going to be the private capital investors that lead us out of that. And frankly, that's okay. Those tend to be the investors that get paid for taking on some additional uncertainty or risk by stepping back into a market that hasn't fully gone through a pricing discovery cycle. So I believe that the next duration of time will predominantly be private capital, whether that's exchange buyers are kind of drying up a little bit just as transactions are slowing down, but family office capital or even some of the syndicators that don't need the 80% leverage to hit really, really high returns and are investing in apartments for fundamental reasons and putting an appropriate risk-adjusted return on the risk that you're actually taking on buying a high-quality Class A building like your asset that you're referencing is. And
what about the workforce housing? What are you seeing there? Because obviously that's been largely either, private syndicators or maybe a JV with, an institution or quasi-institution. What are you seeing there? Is that the same buyer pool, just smaller?
I would say it's a bit smaller in the 80 space right now, for sure. It's interesting. Historically, that's where all the rent growth has been. 2015 to 2020 was a pretty prolific supply cycle for DFW. So the top end of the market was feeling more pressure or downward pressure on rents, or at least flat rents, and the inability to really move concessions and stabilize the asset. And the 80s product and 90s product is where a lot of the rent growth was being manufactured. That seems to have changed over the course of the last 18 to 24 months, where all points in the risk spectrum are seeing substantial rent growth. So whereas the deepest buyer pool was where the most rent growth was in, call it 2019 and 2020, or early 2020 pre-COVID, I would say that's more equally distributed amongst Class A and Class B. This specific moment in time, there certainly tends to be the deepest level of liquidity in the, call it your deal, would be a perfect example. 2005 or 2010 to 2017, 2018 vintage with some operating history, fully stabilized assets. That's where you're seeing the deepest pocket of capital this moment. The 80 space is more challenged, and I think part of that has to do with a lot of the investors and borrowers that were acquiring, more capital-intensive value-add projects last year were reliant upon pro forma lending from the debt funds. Now, you could make a case where that comes back potentially quicker, given Freddie and Fannie's mandate for mission-driven, lowercase a, affordable housing, which a lot of that will qualify for at a high level. But this specific moment in time, that seems to be the more challenged space.
And you just kind of before we started recording, so without naming names, protect the innocent, I guess, you said you just went on the road show up the Northeast and met with a bunch of big institutional type clients, et cetera. What's kind of the mood, generally speaking, of the institutions right now? What are they seeing? Because I'm seeing what you described. Where just got awarded a deal here recently. We're putting together in the Austin MSA. Brand new construction deal. There was, went out with a much higher price, got awarded at a discount of 7-8% off the Whisper. That initial group couldn't perform. Now we're buying at 7-8% below that number. So it feels like a pretty good entry point for us. I think I'm taking the mindset with caution. Now's the time to kind of start buying. Maybe we're at the bottom or near the bottom, buy it at a fundamental discount, see the growth of the market isn't slowing up from a fundamental operational standpoint. So we feel like it's, hopefully we will be paid, like you were describing, being kind of moving without 100% clarity within the capital markets. What are the institutions that are now, from my understanding, largely pencils down? What are they saying? What are they looking for before they kind of come back? Are they out on multifamily, which it doesn't sound like they are? What's going to be the trigger to get those guys back in?
That's a really good question. And I asked that question to pretty much everybody that we met with, the CB delegation that went up to New York to meet with this group, incidentally, the week after the June 15th Fed meeting. So coming on the heels of a week of fairly extreme volatility where there was a 75 basis point swing in the 10-year Treasury yield. So I would say at that moment in time, the tenor in New York was certainly one of, I wouldn't say pessimism, but certainly caution. And an environment where the Treasury yield can swing that much in a short period of time, it's very difficult to make underwriting assumptions that you can defend. So most of the institutional investors were pencils down at that point. Everybody's reticent to say the word pause, but they were pencils down or very, very strategically selective. And I think that still remains the case. Are they out on apartments? Absolutely not. I think the tenor in New York, while it was cautious at that moment in time, and I still think it is, the conviction around multifamily as a sector is still very high. And let's not forget the amount of capital formation that's occurred over the last 2 years or 2.5 years, or even before that, centered around the concept of investing in high growth markets, in high quality assets within commercial real estate, meaning industrial and multifamily. And that sense of wanting and needing to reallocate capital to multifamily investment opportunities is still there. And I think maybe even more emboldened in light of the interest rate increase on the single family side that I think has given a lot of those institutional investors the perception that access to the single family market is much more difficult today than it was 12 months ago when you could get a mortgage at 2.5% to 3%. Whereas today, I know the 30-year mortgage is down, but it's still 5+ easily. That dilutes your buying power. And that closes the back door from a renter perspective, meaning in these high growth markets where there's significant population growth and inflows, if the back door is closed and the front door is just wide open, that just puts significant upward pressure on multifamily rents. And I think that that's going to be a market condition that persists for a while.
Danny, so we talked about sort of from the buyer side, it's been a little choppy, just sort of figuring out the debt. If the debt funds aren't there and you're having to rely maybe a little bit more on Fannie and Freddie right now, if you're sitting there and you own assets that you bought in 18, 19, 20, why is anyone going to sell right now? I know you mentioned before we hopped on the call that, you put 4 or 5 deals under contract. What's the pitch to sellers right now as it's time to go right now? I would say, why do you have to sell right now? If you don't have to sell right now, a lot of the owners are opting not to because there is, and what they believe will remain, elevated levels of rent growth that's going to grow the NOI. I think there's also, maybe consensus is too strong of a word, but I think there's growing discussions around transaction activity that has severely dropped off over the last 30 to 45 days.
That might be a condition as well for high quality assets. They aren't traded as much because it'll be difficult to get your hands on multifamily product. Why would I sell assets in my portfolio that are performing extremely well? So our pitch to owners is less about go now, go now, go now. It's more about what are your strategic objectives and how can we help you solve those objectives? And if it is to monetize something today, here's the path. If it's not to monetize today, here's the path for that. So it's less about advising people to go this exact second. It's more about having an open discussion with owners about what your objectives are. And instead of going in and quote unquote pitching, it's more of let's have an actual open, honest discussion about what you need. And we can provide a solution for that need.
And are sellers wanting you to do the full listing process, 50 tours, call for offers, best and final, or is it more, I'm going to send this to 5 guys and our 5 top clients, and we're going to bring you a few offers. And if we're close on price, then we'll transact, versus the full, I don't know what you want to call it, dog and pony show of the 45 to 60-day process on the listing?
I would say a little bit of both. The deals that I'm referencing that we've been able to find a buyer for and put under contract were done quietly and on a direct basis, more point A to point B. So I think when there's levels of depressed liquidity, given everything that's gone on in the capital markets over the last 30 to 45 days, matchmaking certainly works better than it does in a market that's awash in debt and equity liquidity like we were throughout the preponderance of the last 12 months. So we're definitely seeing a heightened level of point A to point B type transactions happening. We have launched a couple of deals, but that's under the expectation that you're not going to have 50 plus tours and you're not going to have 4 or 5 rounds of bids, which I think is ludicrous to begin with. Even 6 months ago when people were doing that, we weren't. But in any case, so it's a little bit of both. And I think the intermediaries are having to be more flexible on how they think the feel of the market is at that moment in time to advise their clients on what the best road to a successful transaction would be.
So how has pricing been impacted here? So I know we obviously say the peak was February, March, kind of what are you seeing as far as discounts off of kind of the absolute peak to, 30 days ago, probably we're kind of seeing the trough. And then are you seeing any of that kind of bounce back now? And I can think of a transaction I think you guys had, and we could talk through that without naming the name. But where are you kind of seeing for the Class A and the workforce as far as adjustments from the peak on valuations?
So that's a difficult question to answer because everybody's starting point is different. When was the BOV done? When did the deal contract? And it's all along a spectrum. And where we are today is the only thing that's finite. Everything else is along a spectrum. So I'm reticent to specifically answer that question because I don't have a specific answer for you. What I do think is important, and what I think one of the externalities of this whole capital markets correction will likely yield, is there will be a differentiation in cap rate for high quality assets when compared to lower quality, more risk and capital intensive value add assets. That hasn't occurred in years. Think about that. That hasn't occurred in years. So I do think that there's going to be a bifurcation as investors are more selective on what they want to own, especially with a longer term ownership mentality. The location and the physical real estate, I think that there is a flight to quality occurring in the market right now, both from an equity and a debt perspective, where there is going to be probably more capital availability for higher quality assets than the more capital intensive value add assets, at least for the moment. And there's going to be a separation in cap rates. That hasn't happened in a long time. So what the discount is or where we are today versus where we were in February, it's difficult to tell. The deals that we've been working on, the deals that we've successfully been able to put under contract, this notion or concept of negative leverage isn't gone. The severity of that negative leverage may not be the same as it was before, but the cost of capital is also different. So there's so many things that are going into the equation of where's a spot cap rate for my deal today that requires a full underwriting exercise to even remotely come close to being able to accurately answer that question and advise a client. But I do think this theme of higher quality assets and locations garnering more capital attention and lower cap rates and the differentiation in cap rates, I do think that's going to be an interesting outcome of what we're going through right now.
I think without naming the names or getting too specific, you guys had a pretty large deal out. I think you guys came out in May with it. and you're going out, I'm sure, at a little bit lower initial whisper than what you probably thought in March or April when you BOV'd. You probably already discounted that a little bit. And then through the process, seemed like you guys were about getting bids around 85% of whatever the initial was, and the seller didn't sell. I think I heard from one of your colleagues it went under 91% or so here recently. So have you seen a little kind of bounce from the trough of early mid-June to now we are in August? Are you seeing kind of a little bit of a bounce for the groups that didn't panic sell?
So I would say the answer to that is yes. It's almost day by day at this point, but the last couple of weeks, really since last week, Tuesday, June 27th, I think there's been somewhat of a sigh.
July 27th.
We're not fixed. We're not done. Yeah. July 27th. We're not fixed. We're not done. This isn't over. I'm not broadcasting that it is in any way, shape, or form. But as we sit here on August 2nd, I would say there seems to be some semblance of stability in the marketplace. And I think that's for a handful of reasons, as our market is extremely large and complex organism. But what occurred on June 15th and the days following June 15th, the last Fed meeting where the market had priced in a 50 basis point move in the Fed funds rate, but it came out at 75, the inflation reading was higher, was an extreme level of volatility that I think maybe most of us have only seen a couple of times in our careers, COVID being one, and then that week. There was a 75 basis point move in the 10-year Treasury yield. That's a market with trillions of dollars, okay? So to move that market that much is remarkable. What happened last week, the 10-year's back down to 2.6. At one point today, it was in the 2.55, 2.587 range. We're up a little bit, 2.75 today. But generally speaking, the trading range of the 10-year Treasury yield is much tighter than it was following the week of June 15th. That was a Tuesday. Last week, there wasn't that wild move. In fact, the stock market was up last week, one of the best weeks throughout the entire year. And the 10-year Treasury yield kind of hovered in a very predictable range. And I think that at least the idea that maybe the level of volatility we saw a month and a half ago, we may not see that again if the Fed goes by the playbook that the market priced in, which was 75 basis points last week, 50 basis points next meeting, 25 to 50 basis points the meeting after that. If we go by that playbook and we don't experience the level of volatility and there's some stability in the debt markets, specifically the 10-year Treasury, especially if investors are moving more towards Freddie and Fannie, then I do think that will start building a more stable and predictable platform from a transactional perspective. But it is still probably a little early to tell, but it does feel better today than it did a couple of weeks ago. Yes.
Anything out there in terms of buyers? We talked about, you said more private capital coming in. Are terms changing on these contracts? Because I know it used to be 500,000 was a lot of money. Then it was $1 million day one on a lot of these deals. Are you still getting that amount of hard money, or are people sort of turning that down with the volatility in the debt market?
So I think that there's what people want and what's actually happening. And I would say deals that are making right now, you're still seeing similar terms to what you saw throughout the course of the last couple of years, frankly. Yeah, the dollar amounts have certainly increased. But investors that are winning deals and buying deals right now and active in the market, we are still seeing non-refundable money. We are still seeing investors increasing the deposit after their due diligence period. One thing I will say for some investors, not all, is the timeline is getting a bit longer, or at least the request for a timeline is getting a bit longer. And that's in an effort to make sure that they have their capital stack solved for. So that certainly is one thing that we have seen on a number of transactions, is a request for a timeline that is extended from either the original agreed upon timeline in the contract or what a normalized timeline would have been 4, 5, 6 months ago.
And then on those private guys, how are they doing their equity? Is it syndicated equity, $100,000 a piece? Or are they still going to, one guy and getting 90-10 split with that guy? What are you seeing most of?
Both. We definitely have some investors that are syndicating the capital $50,000, $100,000 at a time, but we do have closed-end discretionary funds that are taking this opportunity, and I say that word specifically, this window that has opened up where cap rates have moved and there's an opportunity to acquire high quality real estate at a better basis and better yield than throughout the course of the last 18 months. So it's a mixture of both, James. I'd be interested to hear what you guys are seeing on that side. Obviously, you finance a significant amount of product in DFW, and Mike, you buy a lot of this product as well. What are you guys seeing?
I would say most of our syndicators that we work with raise it 50 to 100,000 a piece. And I guess for the guys who are more experienced, let's say 5, 10, 15 deals under their belt with a good track record, they're still raising in this market. I would say it's a little bit harder for guys with 1 or 2 deals under their belt. And then they thought they had a deep email list. And then that email list of 500 turned out to be like 5 to 10 people that actually invested. So it wasn't as deep as they originally thought. And so the equity is getting harder. And, you were dead on in June and July in terms of the volatility in the market on the bridge side. But right now it definitely feels a lot more stable, especially around Fannie and Freddie, especially around, getting 10-year debt locked at, 4.5, 4.6 in that range on a lot of these transactions. And so we're seeing a lot of people pivot over to agency business right now on the debt side.
And one thing I think is something I mentioned that everybody's using the phrase flight to quality. I think that's true for exactly what you just said as well, James. It is more difficult for the less seasoned sponsors to raise capital in today's environment. And I think a lot of these LPs that have historically invested in the syndication type model are probably looking for a little bit more tenure. That's also true for a lot of the groups that are raising closed-end funds that have a long track record. It's a more difficult capital raising environment for those investors as well, because a lot of the groups that they would go to as investors that are new to their platform are choosing to re-up or double down with existing sponsors. So the groups that are new or looking for, even if they're not a new group, but they're looking for a new pension fund investor or whatever, are having more difficulty right now raising capital for their next Fund 6 or Fund 7 or Fund 3 or whatever, because investors that are in somebody else's fund want to double down there because they know that they've had prior and positive performance with that fund sponsor. So it's not just the syndicators that are experiencing that type of behavior from limited partners.
So my question is, Danny, do you and your group, do you guys need a big hug? Because you guys have just been knocking the ball out of the park for the last 3, 4, 5 years. And then all of a sudden, COVID comes and it slows it down, but it was kind of just a temporary slowdown. But what's the attitude of not just your office, but the offices of CBRE across the United States? Is there questions or any problems or any feelings that this is going to go on for a long period of time, or do they feel that this is just going to be a temporary, little bump in the road and we're going to go back to it in the next, 12 months or less?
I think, so the overwhelming feeling in my shop here locally, and I think across the Sun Belt, is, boy, are we glad that we're in multifamily in high growth markets. As I was talking about before, Paul, that's a good question. I think the investor sentiment, even though we're having a pullback in liquidity right now, we don't have a liquidity issue of we're never doing it again. It is, we need some more certainty before we deploy again. This is a difficult market to be deploying capital. So the investors have conviction around the space. The investors have conviction around the high growth markets in the Sun Belt. So I'm pretty optimistic. My partners here in Dallas are pretty optimistic. Days are difficult. Certainly we're having difficult conversations with owners, but this is really a time, we're viewing this as a time to differentiate ourselves against our competitors. I think a lot of investors and sponsors are using this as a time to differentiate themselves against competitors. And while there are difficult conversations and some days aren't particularly fun, I think the fact that we're sitting in a market that has really high growth characteristics, similar to Atlanta, similar to Phoenix, similar to the other Texas markets, maybe Houston's a little anomalistic just based on the market fundamentals there, I think we're going to be fine. And I think most investors will tell you that we're going to be fine. I don't know the duration to answer that question. I don't know if this is 60 days. I don't think it is. I don't think it's 6 years. I don't think it's 2 years. I think that we have a couple of quarters where it will be slower, but I do believe that at some point the liquidity is going to be forced to be back. And let's not forget one thing. I promised I was going to say one thing that hasn't changed. DFW, I don't know if you guys know this, DFW, okay? Average household income in DFW is $101,000. The average rent check is like $300 less than the average rent check in the United States. The average household income in the United States is $92,000. So we have rents that are less, no state income tax, and average household incomes that are 9% more. And we have two curves, supply and demand, that are not in equilibrium right now. And we have a population that is slated to add 1.4 million people to it when benchmarking 2020 compared to 2030. So those supply and demand curves aren't going to fix themselves overnight. They're not going to fix themselves over the next 12 months. They're not going to fix themselves over the next couple of years. And let's not forget, 2020, there was a 44% pullback in multifamily permits in DFW. That is substantial. That hole is going to hit right at the time when we should probably be adding more housing inventory to this market. So I don't need a hug, although I'd love to give you a hug. What I do need is some more hours in the day, because I think once this comes back and the liquidity comes back, the fundamentals will still be there, even though they will moderate from the levels that we're at. Don't get me wrong. I'm not broadcasting 20% rent growth into perpetuity. But I do believe that this market has characteristics to it that are impossible to replicate and are not impacted directly by the capital markets that will drive rent growth, drive fundamentals. And I'm really glad I'm in apartments, and I'm really glad I'm in DFW. This is probably the best apartment market in the world. Historically, it's been the most liquid commercial real estate market in the world, or one of them on the apartment side at least. And I think that that will persist. I think what we're going through right now is not a long-term systemic problem with the multifamily industry that will persist for years and years and years and years. I just don't see that.
James,
So Danny, we're going to take that.
I don't think Danny needs a hug. I need a hug, James.
Well, Danny, what I was going to say was we're going to take that last 3 minutes and put it on the back of every webinar who's trying to raise money for a deal in DFW. And that just sealed the deal right there. So no, I agreed. I think the fundamental piece is there. I mean, asking people, there's some buyers who are like, I want to buy everything still right now. And, they might be under contract on a deal right now, and they're going back to the seller for a retrade on price because they got it under contract 2 or 3 months ago. Any advice for that guy? Because there's 4 or 5 deals in the pipe right now that's happening. What's the best way? I know you've had to deal with that in the last couple of months. Is there a good way, or is every deal super unique and you just have to phrase it up however you want to do it?
Lose the broker's phone number and just close. Listen, and I'll bookend this with, I certainly don't endorse retrades, so I'm even a little reticent to coach somebody on how to do it. So I do think, listen, retrade or not, or going into a BOV where maybe the value isn't what the owner wanted, or going into any conversation, regardless of what the context is, right now, in times where there is extreme challenges in the capital markets, we've done with our clients on BOVs or pitches or deals where pricing may not be what the expectations were originally. We have found that being really communicative and open and honest is really the best way to move through times like this, but it's also a pretty damn good way to just do things in general. So I would say more communication than less. Open and honest is really the best way to communicate with your counterparty, regardless of what the situation is.
Are you guys really seeing much more of that retrade and that kind of in the rearview mirror at this point? All those deals kind of got set or pulled at this point, and the deals you're setting now have baked in the cake a lot of the bad news that we're hopefully kind of in the rearview mirror for the most part.
Deals that are contracting today, yes, the expectation is if you're buying an asset that's tens of millions of dollars in today's environment, like today, that you know what you're doing, and the expectation is that you're going to perform. So I would say the retrade, reprice, economic adjustment, whatever you want to call it, those were certainly experienced at a heightened level in weeks like June 15th. Where there was a 75 basis point swing in the 10-year Treasury, and the SOFR curve went from this to this. and spreads changed. So like when things massively change, you would certainly expect that there would be an elevated level of that type of behavior. Right now, if you're going under contract on a deal, the expectation is you will perform at that number, and you know that you're not going to get 80% leverage. And if you tell me that you're going to get 80% leverage, I'm not going to likely advise that my client select you as ultimately the buyer, because I don't believe that those leverage levels exist in abundance in today's environment or at all. What we like to hear is we're going to go to Freddie and Fannie, and we have a relationship with them, and we have docs, and we've done deals with them before, and we're going to lock rate and lock spread as quickly as we can. That, to me, is the body language of an investor that wants to proceed with the transaction. Anybody that is going to the debt markets to find substantial amounts of leverage and reliant upon that leverage to complete the transaction, we have grown weary of those types of investors today, just based on what we've all seen over the course of the last couple of months and how quickly that can change.
Oh boy, I am exhausted listening to Danny. He has so much information. Mike, damn it, let's get Danny on sooner than every 5 years. He's a treasure trove of information.
Last time you were on, if I remember the story right, is one of the guys who listened to our podcast cold called you and bought like a $30-40 million deal off you just off our podcast, if I remember right. So still waiting on a commission split.
Deal sizes have gotten a little bit bigger, so I'm expecting somebody to show up and buy a $100 million deal from me today. So.
So we'll have Danny on sooner than later. So certainly do appreciate Danny Baker with CBRE. Danny, if anybody wanted to get a hold of you, what's the best way for them to get a hold of you?
Probably email. I have 52,000 unread Gmails, which kind of block me up, but my work inbox is about as clean as a whistle. So email would probably be best. Danny, DANNY.Baker, BAKER @CBRE.com. And I'm very responsive on that and can get back to you as quickly as possible and schedule a call if that's what you need.
Certainly do appreciate Danny Baker being on. The Professor James Eng, thank you very much for spending some time with us and then talking about the Old Capital Conference coming up here on September 14th and 15th. Get your tickets, RSVP at oldcapitalconference.com. All right. The governor, Mr. Michael Becker, any final words to mention?
Oh yeah, I'm appreciate Danny coming on. I always find him informative and entertaining. So he's one of my buddies, and appreciate both our personal and professional relationship and the time he took today to kind of give a view of the world from one of the more active multifamily brokers in the entire country. So I thought hopefully people got some good, valuable information. Hopefully we'll get this published pretty timely. So things don't dramatically change in the several days from recording to release, which is always a risk in today's environment.
Absolutely.
Yeah. All right. We can talk on Friday. So
that's great. All right, Danny Baker, thanks for spending some time with us. Again, I'm Paul Peebles. Have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.